Well, welcome. This is Brian Klontz with Charitable Solutions. I think we've got about 2 minutes before we're going to start the webinar. You hopefully are able to see your screen here, or more specifically, Ryan's screen. So creative charitable options for subchapter S shares in 2020. So going to wait another 1 or 2 minutes before we get started, and we will be right back. Well, welcome. We still have another minute or two before we get started. Want to make sure everybody has an opportunity to join. See a lot of good friends on the call, so thank you guys for joining too. Just so we can do a quick sound check and visual check somewhere within Zoom. I think you can do a thumbs up or something to give us confidence. Looks like we got maybe 1 or 2. Confidence so you guys can see the screen and hear me well. So all good.
People are used to that at this point.
I think so. I usually say all my good jokes when I'm on mute, so hopefully I won't do that today. So thank you very much for that. We've all become Zoom experts, willingly or unwillingly, I think, in the last 6 months or so. All right, well, looks like the herd is still trickling in, but they're trickling at a slower pace. So I think it's best we'll go ahead and get started, be respectful of everybody's time here, and also my partner's got all kinds of good things to talk about today, so I want to make sure we have time for that too. So with that, I am Brian Klontz, President of Charitable Solutions. My partner, Ryan Raffin, been with us in various capacities the last 6 years or so. So he and I are going to be tag teaming on this always fun and titillating tax topic. Say that 5 times fast. Creative charitable options for subchapter S shares in 2020. So we obviously are experiencing a very unprecedented time on a lot of levels, but there are some unique potential ideas relative to S-corp giving more broadly, but specifically within the CARES Act as well. So we're going to be covering that too. So I'm going to do a very brief introduction of Ryan too. So first, Ryan's an attorney. Many of you have, I think, downloaded the Charitable Gifts of Non-Cash Assets. I will show you if you have not. I might do this at the end too. A shameless plug for a free book. And so you see there, the editor is Ryan. So he had the painstaking process of going through 440 pages of tax and charitable goodness, so is sort of a national expert just in going through that process. But he leads our non-cash compliance and research area, and so many of you have worked with any non-cash gifts have worked directly with Ryan. So he and I tag team on most every non-cash asset that comes in. So I want to take maybe just 3 or 4 minutes if it's okay. Obviously this is a free webinar, so we have to give you a little bit of our mini propaganda here, and I hope it's not redundant and generally helpful. So Charitable Solutions I founded in 2003, and we exist for one reason and one reason only, and that is to help make more gifts happen that otherwise wouldn't, period. And we do that through risk management of both processes and structures to allow good donors with good assets to allow them to make good gifts. And so we do that in a couple ways. On sort of the top right there, you'll see charitable gift annuity risk management. We do a lot of actuarial work. We have a 15-person team, 2 actuaries on staff, and we do basically stress testing of charitable gift annuity pools, identify where risks are and where they're not, and then potential ways and strategies and tactics to collar some of those risks by mainly trying to maximize the residuum value. So anything around risk management and gift annuities we've been doing since 2003, that maybe 250 or so gift annuity risk audits in that time. Bottom right is charitable estate settlement. And so I had a good friend one time, she said charitable estate settlement is kind of like if you have a kindergarten class and the teacher leaves the room. Sometimes not very good things begin to happen. So Gary Sneerson on our team led Harvard's estate settlement area for, I want to say 14 years, also their non-cash area, has been with us about 5 years. So he helps in particular with complex assets within estates, foreign property, again, more on the generally the non-cash side of things, but around the estate settlement component. Then going sort of back to the top middle, we do, again, a lot of esoteric things to help make gifts happen. One of the requirements, of course, are qualified appraisals for some of these gifts. And so we, Ryan actually helped a lot with this, building out a virtual currency appraisal process for Bitcoin and the other 1,000+ crypto virtual coins that could otherwise be donated to charity. So we do qualified appraisals in that space. And then also for life insurance appraisals and also portfolio audits that charities have as well. So do maybe a couple hundred appraisals each year across those 2 buckets. Bottom center is what we're doing right now, I hope, is sort of professional training. This is not CE approved, but we do maybe 2 or 3 of those per week now virtually across a very broad group, I think, very wide scope of topics, obviously all in the charitable tax and planning area. So do a lot of those, usually 60 to 80 talks per year. And top left, what we're going to be talking about primarily today is around non-cash asset risk management. So since 2003, we had created a DECMI Foundation, which is a national donor-advised fund specific to receive illiquid assets. So we don't do anything else other than illiquid gifts, and we never manage anything once liquid. So you can see there since 2003, since inception, it's about $1.4 billion of non-cash donations have been received. That's not ones that we've discussed. That's actually completed transactions. And most importantly, and I'm going to say this twice for emphasis, 100% of those gifts were initially declined. 100% of those gifts were initially declined. Otherwise, we would have never received the referral. So our whole reason for building that component to extend guidelines and process for non-cash gifts. So if a charity is receiving a potential offer of real estate, or talk about S-corp today clearly, then instead of taking that in, either holding their nose or declining it, they can instead refer that over to us. We have the DECMI Asset Trust, specifically designed for S-corp, which we're going to go through again today. And by our then being on the chain of title, doing due diligence, compliance, audit, et cetera, we hold back a fee typically between 1% and 3%, average is just under 2%, and then we're then granting all of those proceeds post-sale. So average gift is about $5.3 million per transaction. We do about 70 to 80 per year. Median's closer to about 3 million or so. So that's the non-cash side. And then finally, National Gift Annuity Foundation. We have now over 500 gift annuity contracts referred by over 350 charities. Same thing. When I started this firm, it was for these 2 areas, was non-cash gifts and gift annuities, because there's only 2 kinds of transactions where the charity can actually lose more money than the original gift. So that's where we focus a lot of our time and attention in that space. So we're licensed in 49 states, the largest independent gift annuity platform now in the country. And same thing, good donor, good asset wanting to do a gift annuity. The charity's not comfortable doing that because they're not registered in a particular state. They don't do gift annuities. It's an illiquid asset. We do retain life estates for gift annuities in some specific situations. So all those things could be otherwise captured. So quickly, that's us. We make gifts happen that otherwise wouldn't. So next slide will be the agenda, and then I'll be passing it over to my partner Ryan here in a moment. So let's see if that forwards through to the agenda. There we go. So the agenda, you can read here. And by the way, and I'm sure this is probably going to come up in the chat, we are not going to be sending out the slides. We had some issues in the past doing that, frankly, with attribution. However, all of this is being recorded. So post-call, you'll actually get a link. It will be on our website, all free. And then you'll be able to use that link, share that link with anybody that you wish. So we're doing the session today and then the session on Thursday. And the way we do it is we pick the best one. So we'll see how today goes. So Ryan's going to do a great job. Hopefully I will too. So if today's the day, then we'll record that, and then that'll be posted to the website. So just a quick housekeeping deferred note there. So the agenda, we're talking about UBIT, so unrelated business income tax that is based on unrelated business taxable income. So we're going to talk about the definition, how it relates specifically to S-corp stock, and some unique tax arbitrage opportunities between the corporate form and trust form based on the two different rates there. You can see there the solution can be a trust form charity, which our Decamai Asset Trust is. There are a number of other charities that have trust form charities that can work as well, so certainly not unique to us. So many charities have this too. It works very much the same way. We'll go through a UBIT case study, then talk about, Ryan will be leading us through the CARES Act summary and S-corp giving more specifically there. Some of the caveats are limitations based on the interpretation of the CARES Act, so we'll be going a little bit into that. Digging deeper, a couple other ideas, sort of advanced planning ideas that might be open for consideration to in certain situations, and then some additional resources and articles we thought might be helpful. So with that, I will turn this over to Ryan.
Great, thanks, Brian. So just going into a really broad overview of what UBIT actually is, that is, it's income that a charity realizes from, as the name indicates, as the slide indicates, they're an unrelated trade or business. And that tax, when it's incurred by the charity is either going to be in corporate form or trust form, so it's going to be paying that tax at the corresponding rate, and it's going to be filing a Form 990T specifically for the UBIT. So that's going to go along with the 990 or whatever other tax forms that it's filing. And it's going to be subject to audit just like any other tax filing by the IRS. I have a note here that the practical applications and compliance of UBIT are particularly complex. I believe it's Bruce Hopkins who has a book that's nearly 400 pages long that you can find online. So to say it's complex is putting it mildly. And kind of the policy purpose of UBIT, I say that it's been around for nearly 70 years. In the late 40s, the IRS realized that there were charities operating businesses that they had received as donations that were not related to their purpose. And so there are two kind of policy reasons for UBIT. One is to make sure that charities are staying close to their charitable purpose. And the other is, frankly, to prevent tax-exempt organizations from competing with taxable organizations. And the first case that kind of prompted all of this was a bunch of lawyers in the 1940s had come to own a pasta manufacturing company, and they had donated it to support NYU Law School. And the IRS did not care for that at all. It went to tax court, and the IRS lost because there was no UBIT law in place yet. So that prompted Congress to pass a law in 1950, 70 years ago now, and create UBIT as we know it. In terms of how we see it being applied today, typically we're seeing that with S-corp stock like we're talking about here. We do also see it with debt encumbered real estate or in LLCs and other pass-throughs. You can have it with partnerships as well, or real estate with active income that's usually flowing through on a K1 box 20 code V, not to bore you with that. And is very complex. And this is why a lot of charities will not deal with it at all. The tax liability is something they don't want to deal with. But other charities, including our donor advised fund, Decamai, will. And we've even optimized our structure, as Brian mentioned, to mitigate kind of these UBIT effects that we're going to discuss here. There are, to dive a little more into when UBIT applies and when it doesn't, it does not generally apply to passive income. So if a charity is holding a rental property, an apartment complex, that rental income is not going to generate UBIT. Same is true of dividends, of course, very common for charities to have investments of that sort. And even most gains are not taxable. However, the big exception is S-corps. S-corps, to the extent of an S-corp holding a charity, is basically not tax exempt at all. All gain items are taxable, as are all income items. So S-corps are a major exception to this exception for passive income items. Another exception is debt-financed income. So when a charity has any asset, to the extent that there's gain realized on that asset when it's sold, if that gain is attributable to debt, that's taxable as well. However, to make it even more complicated, there's an exception to that debt financing exception, and that's the old and cold exception. Generally, you see that with mortgages that are more than 5 years old on property that has been owned for more than 5 years. Doesn't come up super often, particularly in a favorable interest rate environment where you're seeing a lot of real estate investors refinance pretty frequently. So in my experience, usually that exception is not going to get you away from UBIT. And then a couple notes on certain planned giving vehicles. Charitable remainder trusts are not exempt from UBIT, but charitable gift annuities are, which makes sense because obviously when you issue a charitable gift annuity, you're issuing a payment obligation. So that is, on its face, debt financing. The IRS specifically allows charitable gift annuities to be exempt from UBIT. But not the funding asset. So again, if you fund a CGA with an S-corp, the gain from that S-corp will still be taxable. And let's talk a little bit, I guess, about S-corps specifically and how they kind of fit into the charitable UBIT space. And a couple of practical points as far as charities accepting S-corporation donations. I mentioned here that there's a lot of S-corporations out there, over 4 million, twice as many as there are C-corps with 7 million shareholders. That's a big number to begin with, but if you do the quick math here, you can see that most of these S-corporations only have a few owners, 1, 2, 3 owners. They're capped at 100. So we're not talking about like a tech startup that might have hundreds of investors, multiple classes of stocks. S-corps can only have a single class of stock. Usually with an S-corporation donation, it's actually very easy to have the stock transferred and donated over to charity because you're only dealing with a couple people who need to sign off on the transfer. Not the case with other types of entities, partnerships, where you might have a general partner who needs to sign off. Or a C corp where the board needs to sign off. Those things you don't run into as often with S corps. And one common question we get from donors, or more specifically their attorneys and their accountants when they're doing a donation of an S corporation, is will we blow the S election if we give this to a charity? Can a charity even hold this S corp stock? Well, yes, in 1998, Congress specifically allowed it. And you can point even to the exact code section, which I've done many times. It's 1361C6, where charities are specifically authorized to hold S-corp stock. It still comes up. Usually the advisors of S-corporation donors are very concerned about maintaining that S election, and rightfully so. And as we mentioned, when it comes to S-corp donations, the UBIT is applying to really all income items. So it's not just the gain on sale, which is usually the most significant item, but also on all ordinary income, passive income items. So if the charity is holding the S-corp for an extended period of time, even if there's no gain being realized necessarily, if there's an operating business there, the income that's being allocated to the charity, that's all taxable. And this is one of the reasons that a lot of charities are reluctant to accept S-corp stock, particularly if they're in a corporate form, as we're going to discuss. But the other thing is, like any other non-cash donation, the donor is going to receive a fair market value deduction. That's usually highly advantageous with S corporation stocks because the donor's basis is typically very, very low. It is often zero. There can be a reduction for items, either Section 751 hot assets or debt financing. That can reduce the benefit. But generally speaking, an S corporation donation typically looks very advantageous from a tax efficiency point of view for the donor. And now to talk a little bit about the tax rates here, as we're going to, and Brian is specifically going to illustrate the difference between a trust form charity and a corporate form charity holding S corporation stock. It does bear mentioning what these rates are, since we're really talking about how can we mitigate these? How can we make sure that less money is being paid in taxes by the charity? The trust rates are basically the same as the individual rates, except less advantageous. You're hitting the top brackets very, very quickly with a trust. 12,750, as it says there, I think is the current one. So it's safe to assume that with a trust in a charity in trust form, it's going to be operating at those top rates. As of 2017, corporate rates, of course, are now a flat 21%. So that's down from, I think it was 35% before. So corporate rates are actually lower. And then capital gains are now comparable for both. Capital gains are income for corporations, but now that's 21%. Capital gains for a trust, same as for an individual, top rate is 20%. So they're comparable in a lot of ways when you just look at the rates on paper. But as Brian is going to illustrate here, there are ways to have a trust form charity accept the S-corp stock and pay tax at a much lower rate, particularly when it comes to capital gain.
Well, thank you, Ryan, and that's like the best tax cliffhanger ever. So I know you guys are riveted to say, now what's next? What's next? Here it comes. Here's the next chapter. So we thought it'd be helpful to go through just a typical trust donation flow, so they can be so clear. This is still a public charity. Most all of these are donor-advised funds. They don't have to be, but typically they are structured as donor-advised fund sponsors, and they're simply electing in their 1023 exemption application to be in trust form versus being in corporate form. So to be very clear sort of how this works. So we're going to pick on California because from a state income tax standpoint, there's easy to pick on that, but this is an actual case. So it's a California donor, and she had S-corp stock, and she's going to donate $1 million of that S-corp stock to the public charity that is in trust form. So the next step of that will be that she would get then a deduction at the full $1 million, so starting there, assuming, as Ryan indicated, there are no ordinary income elements within the S-corp itself, clearly assuming that she had a qualified appraiser completing a qualified appraisal and so on. So we're sort of glossing through some of the compliance and substantiation requirements there. But to the extent then, as Ryan also said, let's say that we owned it for a week and we turn around and sell those shares a week later because we're having to take a carryover tax or cost basis from the donor, in this case 0, then when we sell, we being the charity, sell that stock, we're now having to pay tax with $1 million of recognized income. So 0 basis, $1 million sale, $1 million of recognized income. And so that would be at the 20% federal rate. We're not even talking about state rate. We're sort of glossing over that, sort of carving that out. Clearly, this would even make it better. Our foundation you see there is in Nevada, and that's not by happenstance. So Nevada has no state income tax, interestingly, only to me maybe. Nevada, I believe, is the only state in the union that constitutionally can never have an income tax. So we had other state selections, but chose Nevada in 2007 when we created this entity. And so in that case, now we're recognizing only capital gains at federal rates because as a Nevada shareholder, we're not going to be subject to the California state income tax rate. So that's at the 20%. So now right now, just as Ryan said, this sounds a lot like a corporate tax rate. Corporate tax rate's 21, trust tax rate's at 20. I hate to be bad, but who cares, right? Here is the secret sauce. The secret sauce then is because this trust is taxed like an individual for long-term gain purposes, we also have to complete what's called the 990T, which is our UBIT tax form. All you need to know is this. On the tax form, it basically says how much income was recognized in that particular year. We say $1 million. Then it asks, has the charity made any cash donations, grants, to any other public charity? That's all we do. It's a pass-through. As soon as it's sold, 30 days later, it's being granted out. And there's this wonderful box. I cannot remember the box, but there's a box number. It's glorious. And it said how much was donated out. In this case, it might be roughly, this would be about right, 980,000 of the 1 million was granted out. So in that case, we now, because we're taxed like an individual, under the current tax law, we're not even talking about the CARES component yet, under current tax law, individuals can get up to a 60% of AGI deduction for cash contributions to other charities. What does that mean? That means we're able to take a deduction up to $600,000 against that $1 million of income. And then that reduces our tax to an effective 8% rate. So in this case, you see there bottom right, $80,000 in tax. Can't get rid of all of it. Maybe, there's my cliffhanger back to Ryan, maybe based on the existing tax law. So in that case, if this were to otherwise go to a corporate form charity, which we're going to go through those numbers in a moment, that might be closer to a 20% tax versus 8%. If we're talking about a $40,000 gift, that sounds bad, who cares? We're talking about a $1 million donation, you're talking about a 12% tax delta. That's chunky. That's $120,000 of not just saved taxes that the charity would otherwise have to pay, but is $120,000 of net gift, if you will, that can be put toward the impact and purpose that the donor wished for it to go to. That is the secret sauce in a trust form donor advised fund model. So on the next slide, we go through basically that sort of breakdown, and this is a case study. So in this case, I won't go through all the detail because we really just did this in broader form, but we actually had a registered investment advisor. She had founded her firm about 25, 30 years ago. When you found your firm, sort of the joke is you always do it in the garage. It's always successful. You did it with $10 or something. So her cost basis was 0. She had an existing junior partner who wished to buy more equity into her registered investment advisory firm, again in California. And she said, that will not be good because if I sell my portion, which she wished to do, to the new investor, actually the existing investor who is the junior partner, she said, A, I'm going to have the 13.3% tax for California plus the 20% gains tax federal, and I'm charitably inclined anyway. Financial advisor, help me find a solution to that. And so the solution was making the transfer of that stock over to Decamai Asset Trust to create a donor-advised fund. She gets the deduction, as you know. It's in Nevada, so no state income tax. We then are able to sell that to the existing partner, still at full fair market value, make sure that's clear. So if it's a related party, disqualified person, et cetera, get glossing through some of those things. But then we're able to get the 60% deduction against our AGI. So yet again, it ends up with an effective 8% capital gains tax rate. So, and instead, you can see there versus a sale at the bottom, it'd be closer to a 70% would be the effective rate there if it's a corporate DAF. So we got a schematic. Everybody loves schematics. I think about 5% of the people on this call like schematics. All the rest are like, oh my gosh. But we thought this would be helpful just sort of visually step by step. So if you go to sort of top left to right, you've got Joe Smith. He's our donor. And he may say, look, I'd like to make a charitable donation, but I don't want to give it all away. I love you, charity, but not 100% worth. How about I give 20 shares, you see they're in the middle, to the donor advised fund in trust form. It can be Decamai or others. I think there are 3 or 4 people on this call that also have these. So again, these are not overly magical. And so then that donation is made at the 20%. He then keeps the other 80% himself. By making the 20-share donation to Decamai, he, of course, would get an income tax deduction, the arrow going back to him. Now we have the buyer in the top right. The buyer doesn't care if he or she is buying 100 shares from Joe or 80 shares from Joe, 20 shares from the charity, as long as they're buying 100 shares at the price that they wish to purchase it for. Decamai will say, we are eager to sell our shares to a willing buyer at a hopefully very reasonable price. And therefore, we would sell our shares at the same time Joe sells his shares. 2 very key points. I'll do it big 2. Big 2, 2 points. 1, about 75% of all of the non-cash transactions that we help complete, 75%, are not the entire interest. It would be an undivided fractional interest, whether that's real estate, whether that's an S-corp or LLC, any kind of illiquid gift. The donors typically are giving a fractional interest in that overall entity or their overall holding. The second point, number 2, this is even bigger. Ryan mentioned how many S-corps there are relative to C-corps, almost double. If you look at S-corps related to C-corps and LLCs, there's still more. So if any donor or any of your clients say, I own a privately held business, the odds are very, very good it's going to be an S-corp. The big second point is that when you think about charitably inclined donors, if you are in the smallest community you've ever been in or the largest urban area you've ever been in, for my almost now 30 years of experience, always the most charitably inclined people are real estate wealth, with shown what? Real estate, and privately held business wealth, the majority of which own S-corp shares. So the point is the 2 most generous type of people own these kinds of illiquid gifts, and one of the big chunks of those own these kinds of shares. So now jumping back into the schematic, which I know you're eager to do, you now have the sale. So Joe Smith gave 20 shares to us. We sold those to the buyer. So now we own the shares. But now remember, we're having to recognize all
I think we might have lost Brian. I know he's had some internet trouble lately, so I'll try to pick it up and see. We'll see if he jumps back on. So where he was in this schematic, the charitable DAF in trust form, that's Decamai, that's us, in this case, has just sold the shares and it's recognized the gain. Oh, Brian, are you back? Nope. Okay. So it's recognized the gain. It is going to incur some tax, as Brian just outlined, but because it's in trust form and it's about to make a grant out, it should only be recognizing tax at 8%. So in order to lock that in, it of course needs to make a charitable grant over to another public charity. So it is going to grant out the cash net of that income tax that it expects to pay, that 8%, and that's going to go oftentimes over to another donor advised fund. In this schematic, in this example, Joe Smith has his own other DAF, the Smith Family Donor Advised Fund. One DAF can certainly make grants to another. It doesn't matter if it's a trust form DAF like Decami. So Decami makes that grant. The money moves over to Joe Smith's other donor advised fund, where, as you can see on the schematic, it can make grants and be invested just like is common for 99% of donor advised funds. But Decami, in making that grant over to the Smith DAF, gets the UBIT deduction, the charitable deduction, reducing that gain, that 20%, down to the 8% that Brian outlined earlier. Brian, are you back on audio? No, okay. So the next slide here, we have a number of scenarios, different ways that a client or a donor with an appreciated S corporation stock or business could realize their charitable goals. So we've got 4 situations. The first one, very simple. The client's just going to sell the shares in the S-corp and pay the tax, give whatever they have left over. The next one is the one we were just talking about, number 2, highlighted there, giving shares to the trust form charity Decami. And then Decami is going to be granting those net proceeds over to the client's donor advised fund. Third one, again, fairly common. The donor is going to be giving the S-corp shares to a corporate form public charity. That's not as common with S-corp shares for the reasons we've been going through, but that sort of transaction quite common. And number 4, a client giving to a private foundation, which is not usually the most tax efficient way to give. So in our example, we have now S corporation shares with a fair market value of $5 million and a basis of 0. Again, a basis of 0 is very common, and when the donation happens, no matter what the charity is, they're going to take that basis. Some assumptions as far as the tax rates there, 35% income, 20% capital gain, 5% state income tax rate. Of course, that state income tax rate can be significantly higher if it is a high tax state like California. But you can see kind of the results here in each of the 4 scenarios. Really, what we are emphasizing here is that the total amount left for charitable giving, that second row, is highest in our scenario, number 2, and by a fairly significant amount. The tax benefits in the top row are not as great for scenarios 1 and 4 with a private foundation. Obviously, the deduction is very, very limited, oftentimes not a good option for clients or donors who are looking for a big tax deduction. And number 1 as well, that's just showing a result where, although there is a tax benefit to giving cash after the fact, the amount of taxes being paid to get to that point, to give those after-tax dollars, really reduces the benefits. So you can see that the benefit is greatest when the donor is giving pre-transaction, pre-sale shares in the S-corp to charity, and then the charity is selling those shares. But with the trust form, number 2, there's a great benefit because the trust form charity versus the corporate form, number 3, the trust form charity is paying a lot less in tax.
So just moving, I'm back on, Ryan.
You're back on?
This is your section anyway, so I'm gonna, for the purposes of the recording, blame my daughters for sucking up all the Zoom time because they're doing virtual school today. So again, they'll be punished later. So anyway, this is your section.
Sure, thanks, Brian. So to take a step back and talk about kind of why we're doing this now, as everyone on this webinar knows, I'm sure, earlier in the year, Congress passed the CARES Act. It was designed to provide relief against the impact of the COVID-19 pandemic. It is very broad, many provisions, but the one that is of interest to most people in the charitable space is that it increased that AGI limitation for cash donations from 60% to 100% for the 2020 year only. So we were talking about that 60% deduction against AGI for a cash contribution to a public charity. In 2020, that is now up to 100%. Congress did limit that a little bit. That is only for cash contributions. So non-cash, whether that's S-corp, real estate, partnership, cryptocurrency, anything, that's not going to qualify for this. And Congress was explicit in saying that you could not get that 100% deduction for a donation to a donor-advised fund. And they say both the establishment of a new donor-advised fund or maintenance of an existing donor-advised fund. And that's true of supporting organizations as well. So a significant benefit from the 2020 CARES Act for individual donors, and as we'll see, possibly for entity donors, but with some limitations. Now, in the context of S-corporation giving, you might be wondering correctly, well, Ryan, you just said that it doesn't apply to non-cash giving, so how does that help the individual donor? It only applies to the cash donations. With non-cash, you're still limited to that 30% of AGI deduction limitation. But as Brian and I just went through, the charity and trust form does qualify for a deduction that matches the individual treatment for cash grants to other charities. So in the way that we go down from a 20% capital gain on S-corporation shares that get sold, we make that grant over to another public charity and we receive, because it's a cash grant, a 60% deduction. The CARES Act has increased the deduction for that type of charitable giving to 100%. So does that mean that when the Decami, the trust form charity, makes a cash contribution to a public charity, not a donor advised fund, but just an operating public charity, from the sale of S-corp stocks, could it get 100% deduction? Well, if you look at the text of the CARES Act, it doesn't exclude trusts. So our thinking is that if Decami is making a grant of cash to one of the qualifying charities, and again, that does not include a donor advised fund, it has to go to an operating charity that is not a donor advised fund or a supporting org, it should be entitled to 100% deduction. And what would that do? That would then offset the taxable gain from the sale of the S-corp entirely. So instead of taking a 60% deduction against that gain, we're talking 100%. UBIT now going down in theory to zero. What does that mean? That's really increased tax efficiency. That is a lot of additional charitable dollars available for grant making to charities that need the money. And this is the whole point of this provision in the CARES Act, which is one of the reasons that we're really intrigued by it, by this strategy. But it's worth noting that this has not been something that the IRS has really opined on yet. It could take a very literal position and say, yes, individuals are allowed to do this and corporations are allowed to do this, but trusts don't get mentioned at all. We think that's probably a drafting oversight because the S-corporation UBIT deduction is a very limited circumstance, and it probably was not on the minds of Congress when they were drafting this. And the spirit of the law does encourage charitable giving. It's strange that the IRS would take a position that would discourage trusts from doing this, particularly since trusts and individuals are otherwise allowed to take the same deduction when it comes to cash. In a prior year, as we've gone through, it would be a 60% deduction. If it's been raised to 100% for individuals, why not trusts? We're still trying to incentivize charitable giving for trusts, just like we are individuals. So that remains to be seen kind of how that's going to bear out, but we've spoken to experts that we know, and we believe that it should be it should be the result that that 100% deduction is available to a trust form charity. And just to make this a more visual thing, returning to that schematic that Brian and I went through, if you're thinking about the structure, this is how different it would look, which is not that different at all. I've highlighted in the yellow box there really where the difference is. The transaction, the donation, that is all the same. The difference is simply that Decami, the Charitable DAF Trust, is making a grant to a charity, not to a donor advised fund, and receiving the 100% deduction. So Joe Smith loses the advantage of being able to fund his family DAF, but what he gains in return for that is that the Decami, the Charitable DAF Trust, is moving more money because of that 100% UBIT deduction over to the charity. And this is why I was saying it fits in with the purpose of the law. We're putting more money by doing this into the hands of the charities that need money. And that was obviously the whole purpose of including that provision for 2020. Congress is trying to incentivize charitable giving this year because of the pandemic.
Well, I think, if I'm heard, I hope I'm still coming through. Be taking this the rest of the way here. We have a couple more slides left, and we've got a couple questions. I'm doing my best answering the Q&A in the Q&A section, and it looks like Tony and a few others have talked about, or actually included those in the chat too, so we'll do our best there. I'm guessing we've got probably another 5 to 7 minutes left on these few slides, and we hopefully will open that up. One other housekeeping note too, even if you have questions that we don't answer directly, you guys may have attended the one webinar we did last month with John Severson on using the CGA as a stretch IRA alternative, and we spent a lot of time, had a lot of great questions there, compiling those questions and then answering those to the group or to the individuals after. So bottom line is we'll do the same thing, so to the extent that you've got questions and we're not able to answer it during this call. So limitations, I think that's a word nobody likes typically. When does this sort of not work? And so first thing is, as Ryan said, that the incentives here are to create more charitable gifts, not all the time and not to private foundations supporting orgs and DAFs, but to specific charities within this calendar year. And so it's only going to be if the charity makes the grant within this year, or said another way, if the donor is making the contribution by 12/31. Second, we already talked about, Ryan mentioned, it cannot be a grant to a new or existing DAF, or again, a supporting org would be another public charity that would otherwise be excluded. But I know that my friends at Community Foundation, Deneve, had asked a question that I think everybody got the answer to, but there are a number of ways to still provide grants like this, similar to the QCD rules around what is a donor advised fund. And without going off topic too much, I mean, the Pension Protection Act finally gave us a clear definition of what donor advised funds are. And for many good planners and creative planners, then if you know what the definitions are, you can then pluck some of those definitions to purposefully make what I sort of call from time to time a defective donor advised fund, which means it's not a donor advised fund. It could be a designated fund or agency endowment or field of interest fund, et cetera, that otherwise would qualify for QCDs. So at least the way that we're thinking about this, again, more generally speaking, none of this is tax financial advice, so we'll throw that fun disclaimer out right out of the gate. But to the extent that you are making grants from a trust form donor advised fund or receiving gifts directly from donors, that really the QCD rules, which clearly was the framework that they used here, would generally apply. So really any other funds, for example, at a community foundation beyond donor-advised funds or a supporting org that's attached to them. Second, actually I should say third, we talked about, well, the supporting org piece, but the normal grant limits would apply to a private non-operating foundation as well. So to the extent that it's a private operating foundation, typically that would, but otherwise the limitation would be for the non-operating typical family foundation type entities. So on the next slide, we have sort of digging deeper. So this may be kind of interesting. So the first thing that we spent a fair amount of time on, frankly, even in past years, never mind this year, is looking at funding gift annuities, since we've got both the non-cash sort of service line and bucket and capacity, as well as the gift annuity side with S-corps. And so if you fund then an S-corporation, using S-corporation assets to fund the gift annuity, in particular if that charity receiving the gift annuity is a trust form charity, now you're back to a couple things. One, charitable remainder trust taking in S-corp is usually just bad. We can go through that if you'd like, but there's a 100% tax on UBIT, as Ryan mentioned earlier in the session today. So that's just bad. Versus S-corp funding a gift annuity can still be reducing that tax down to that 8%, at least under current law, and potentially down to 0, as Ryan mentioned. We actually use a somewhat unique gift annuity contract that adjusts the payment to the actual net proceeds received, and so we're able to basically adjust down for what that tax would be. So long story short, S-corp to CGAs can work quite well anyway, but if this CARES interpretation would work in terms of the 100% deduction, it would work really, really well for those donors with S-corp looking for life income, deferred or otherwise. It could be a very unique planning opportunity. The second piece is, which came up also in the Q&A, which is a great question and something we're trying to noodle through a lot, so we don't have the answer either. But what happens when you have sort of non-UBIT grants to cover UBIT grants? So what does that mean? If I'm an individual, let's sort of go there, and I say I'm making a grant for the 60% charity, let's say it's a donor-advised fund, but then I want to give another 40% to a food pantry, as an example. How does that bifurcation actually practically work on the 1040? And how this flows through is something we've thought, and Ryan and I discussed even this morning. I'm not sure how that's going to work in terms of how, again, those can be partitioned. So you sort of have that ambiguity. Now when you go over to the donor advised fund that's in trust form, I mentioned too, Decamai Asset Trust has been doing this for a long time. We have about $350 to $400 million of just unused charitable carry-forwards, massive carry-forwards from all the prior year deductions that keep carrying forward just like an individual for an additional 5 years. So now an interesting question could be, well, wait a minute. What if some of those carry-forwards could somehow be identified or tagged as not having gone to a donor-advised fund, which would be limited as we discussed, but instead went to a university? Could we use that tagged carry-forward against 100% of our UBIT potentially for this year? So that's another issue. And what if donors are doing the same thing, which they are? So when you're looking at carry forward, there's never really been this direct partition between the two. So this is always the part of the session where you say, these are interesting things to think about. Not entirely sure how that would play out, but from a planning perspective could open up some interesting solutions. The S-corp is definitely a solution. Even at the 8%, it works great relative to a CRT, but at the 0%, it's great on steroids. So the last slide, which many of you I think are maybe happy to see, are just some UBIT resources. So I know you're going to be very eager. You probably have already done this. So as soon as Ryan mentioned the Bruce Hopkins, 440-page text on unrelated business taxable income, you guys said, whoa, that's what we're going to go get. So that really is, in my view, the treatise on this specific topic. And as Ryan mentioned, I mean, it is an incredibly complex area, open for a lot of interpretation, never mind the CARES Act. So it's a complex space that you add ambiguity within a quickly drafted act, and sort of layering that on top creates some more fun. A person who worked with us for a number of years, Laura Peebles, retired a couple of years ago, but she wrote really the first article that I ever saw on understanding the arbitrage difference and the tax savings between, well, what if a corporate-owned charity, corporate-form charity, were to receive S-corp stock versus a trust-form charity? So she sort of seized on that very quickly. Chris Hoyt, who I think many of us know, has written a lot on the topic as well, great ActTech article, and much of that, frankly, has been repurposed into our Charitable Gifts of Non-Cash Assets, again, free book, that can be downloaded off our website. I do want to mention it's funded by the Charter Advisor and Philanthropy Program. Leon Levy actually provided the donation to fund it, so included that link as well. But our Chapter 3 is just S-corp, start getting very deep into that. And again, Chris Hoyt wrote the advanced section of that as well. So with that, I think we've got 5 minutes. So this is not the stump the speakers part of this session, I hope. But if there are any additional questions, I see a couple in the chat. So let me see. Oh, so this is Tony asking about sort of the timing of the deductions. We actually talked about this a lot. This all has to happen in terms of the grant in 2020. So the 990 filing that comes up, we talked about that this morning too, in November 15th as the filing deadline. That is for 2019, so it really will be activity for this year. So we're actually not going to be doing the full calculations until 2020. So the issue really becomes on a fiscal year. I don't think that's going to have any impact because it's really going to be based on the calendar year 2020. And I'm reading that question very quickly, so Tony, I might not be getting all the detail there, but it really is at least right now activity for 2020. We have had another question that came up talking about what are the sort of likelihood or probability that the CARES Act could otherwise be extended. Who knows? I mean, you've obviously got a Congress in flux, president in flux. We have the pandemic, which is painful. That seems like it's getting better in some areas, not better in others. And God forbid we have another disaster-related issue that could otherwise give justification for some level of extension. So no clue on any of that, but at least the known regime we have now, which again is still murky, is the 2020 being the period. And then here's another great question, sort of, there isn't a lot of time left in 2020, sort of what are the provisions? I think a strategy for charities, number one, to be blunt, I wouldn't focus on this. This is crazy deep into the pool esoteric. I would focus on, if we aren't a DAF, understanding that there's this 100% of AGI deduction for this year only for gifts of cash, and I'd be focusing on that very hard. And for your maybe major donors that otherwise could be more non-cash asset-based donors, certainly this otherwise could help incent them to complete the gift this year, in particular if the grant would be made this year. To Tony's point, though, to be clear, because we have so many carry forwards, we're getting those grant UBIT deductions anyway. The question is the parsing between other DAF grants that we make, which are by far the majority, versus other direct charity grants that we make too. So let me maybe jump back in. I've got this, copy of the presentation. The copy of the presentation will and will not be available. How's that for cryptic? So we will not be providing the slides themselves, but we will be providing a free link, and then we'll be posting this on the CharitableSolutionsLLC.com website. So you'll have this whole thing, and obviously we do it in such a way you can fast forward all the stuff that you guys know how to do to jump to different sections as well. So yeah, you're welcome. And let's see, maybe one more question. Let me see. So could Decamai Donor Advised Fund Trust grant to multiple charities to satisfy a donor who wanted to give to more than one charity? We do that a lot, and a lot of times we'll get a referral from a very sophisticated charity that'd be very comfortable with a real estate gift or perhaps an S-corp gift, but they say the donor also wants to give to 3 other charities. And we love other charities too, but we don't want to be the one centrally processing all of that. and perhaps even our governing documents don't even allow us to make grants to other charities perhaps that aren't related or affiliated. So in many cases, they will then make that referral to us or other donor-advised funds in this space. We have a number of great partners actually on the phone here today. And then we can bifurcate it at that level and then make the grant out. Another quick question, it said, how long will Decami Asset Trust hold a private interest? We actually are comfortable, sometimes painfully, holding it for a longer term period, really an indefinite period. There can be some rules called excess holdings or business holdings requirement that might limit that to 5 years. That's an IRS rule, not a Decami rule. Other charities, in fact, again, partners on this call are not as comfortable holding it longer. It gets bumpy. There can be audit issues, appraisal issues, just, you know, hey, this was supposed to sell in a year or two, and now we've owned it 5 years, sort of the now what issues. So each charity will have its own gift acceptance policies and guidelines, but we actually have a number, about a dozen funds that are designed to be very, very long-term holds as well. And then as there are liquidity events, then grants are made to the charities they were trying to give to begin with. So with that, I think we were exactly on time. Ryan, excellent job as always, and thank you for jumping in with my technical difficulties. I hope it looks like we rehearsed that, because we did rehearse that, right? So actually, it happened. Got to love my daughters. So I do hope this has been helpful. Any other questions you have, definitely go ahead and continue putting that in the chat or the Q&A, and we'll do our best, as I said, to get that back out. And we will have another webinar on another exciting topic coming out next month. And then again, all of our webinars are linked to our website. Download all of them for free and watch anytime or forward it to other people you think might be helpful. So thank you all very much. We'll go ahead and end the broadcast and appreciate all your activity and questions. Thank you.
Thank you all.